Thank you for joining me. I'm Alex, and I would like to have a look at Cisco today. So, what they do is they make networking and conferencing systems, mainly aimed at pretty big companies. So, they make network switches with like 48 ports for data centers and for racks and everything. So, they've been around for a long time. They're the number one manufacturer of networking equipment. Current price is $48.46, which gives them a market cap of $206 billion, so definitely not a small company. Dividend yield currently just under 3% with a 52% payout ratio, which is definitely not bad. Revenue $52 billion, earnings $11.6 billion, which is nice, and up 10,000% from the year before that. That doesn't necessarily mean much, though. So the previous year, they had a big income tax expense of $12 billion, which kind of explains that. The year before that, they were just under $10 billion, just under $11 billion. So earnings are in line with what they had before last year. Last year was kind of a, one-time thing. Total assets $98 billion, total liability $64 billion, which gives them a total stockholders' equity of $33 billion. So obviously, pretty much that whole loss is the $12 billion that they had to pay in taxes. So they all came out of short-term investments. So that brings us to risk factors, of which there aren't really a whole lot. On the conferencing system side, obviously, things move towards more consumer level equipment with software instead of all integrated things. But in big companies where response times are important, where reliability is important, obviously they tend to still go for Cisco systems. And so I don't think there are really any short-term risk factors that will come into play. Over the long term, I would assume that Chinese manufacturers are trying to build switches and conferencing systems and everything, but I think they're still years out in massive numbers. So I don't see any risk factors. I don't really see much of a downturn. I don't really see them losing a lot of money if there were a recession. This is a very safe business for pretty much any time. What usually happens with a recession is that people stop their future spending, which means that if there's a recession, let's assume there's a recession in 2020, that means they will stop investing, which means Cisco's earnings go down in like 2021, 2022, maybe even a year after that, because the planning slows down instead of the current spending. So it kind of always lags behind. So with that said, though, I think that even in a recession, there is a base level spending that's going on, and obviously the move to cloud computing makes them more valuable now than ever. So I think that it's a very safe and very stable company that I feel like a PE of 19 is pretty cheap for, especially with a dividend yield of just under 3% with a 52% payout ratio. So that means they might be raising the dividend later, and they have much room to do so. So I think for a growth investor, I think that this is probably not the company for you right now. I think that once China gets more on the cloud computing bandwagon, then Cisco might expand there, and maybe India as well. But for now, I don't think the growth is really going to be in the double digits anytime soon. So growth investors probably out. I think for dividend investors, this is a very attractive company, mostly because of the dividend yield and payout ratio, but also because of the stability of the business, and the same goes for a value investor. So I think that for a value investor, this is definitely a company you should be looking into, and I cannot recommend them enough right now, especially with a PE of under 20. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.